It was an interesting session on Wall Street with the S&P 500 closing lower by 0.3%. While that end result doesn't sound too dramatic, it was how we got there that was really interesting. We actually were up for most of the day, and it wasn't until the last couple of hours that we saw the market start to roll over and gradually pick up steam as we headed into the close, and then it culminated with a sharp sell-off in the final minute of trading. In tonight's video, I'll show you on an SPY basis that ETF was down an entire dollar in just 1 minute's time, and then was down another dollar in the after-hours session immediately thereafter. We'll then take a look at that information and see how that impacts our postures from an intermediate time period perspective, where we did have some different changes that I want to alert you to here tonight. We'll get into some sector analysis, looking at our sector selector tool, and then also taking a look at some of the sectors that sold off today. There were two in particular that stood out. One sector had every single component in the red today. Another one had all but one in the red, and that particular sector actually ended with an oversold cluster signal, which is fairly rare for it. And then finally in the video tonight, I'm going to do a trade application example on one of my favorite dividend kings out there with a really interesting chart setup that you have not seen very often throughout history. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's February 28th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area and make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. We'll also tell you which stocks are in the overbought and oversold cluster signal area in the S&P 500 at the bottom of those emails. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. In fact, tonight's trade application example from the video was something I was tweeting about here earlier, so sometimes you'll get a sense as to what David and I might be discussing in the Market Outlook videos later if you follow us there. So we really appreciate your support. And then last but not least, we do have a presence on Facebook as well. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. As you can see, I've got the heat map of the S&P 500 pulled up here in front of us. And it was a little bit of a mixed session, kind of an odd day to be honest. We seemed to have more bullishness early on in the session, and we actually retained much of that bullishness until really late into the afternoon. In fact, it wasn't until the final minutes candle that we really kind of took a little bit of a nosedive. Now, it wasn't a huge deal because the S&P 500 was only down 0.37% when it was all said and done. Nonetheless, we were green for most of the day. And then just had this slow drift until the end, and then finally the last minute we had a lot of sellers come in, perhaps on the market on close types of orders that were out there. So as it stands here, lots of green, lots of red, kind of dependent upon circumstances. Of course, we're still in earnings season here, so we're still getting through a number of the retailers as an example this year, or this week I should say. As we look at kind of the red portion of the charts first, let's concentrate on energy down below. Notice that it appears to my eye that every single energy stock was lower today. Let's just verify that. And indeed, that was the case. Every single oil stock in the red. And we'll talk about the sector selector here after a little bit, but that will confirm what we are seeing right here, as well as energy has really kind of fallen, at least on a relative basis, compared to so many other sectors that are out there. My oh my, how 2023 feels tremendously different than 2022 from a variety of reasons, but here's another key one where energy stocks are laggards this year, whereas once upon a time last year they were pretty much the only game in town to the upside. So it's been interesting to watch that unfold. You also saw that the consumer staples area struggled here today. Remember, that's more of a defensive area of the market, so that's not necessarily the worst thing when you see that type of behavior. Generally speaking, it means that money is drifting towards more cyclical and growth-oriented areas, and all things being equal, that is usually a sign of a healthier stock market, not the opposite of that. We also see that the utilities really got stung here yet again today. Remember, we were talking about the utilities on Thursday when I was with you, and we were talking about how they had an oversold cluster signal, and they had another one, maybe 2 weeks ago or something like that. So this has been consistent selling that's been taking place here. Remember that utilities are very interest rate sensitive, and we've seen 10-year Treasury yields across the board go higher in pretty dramatic fashion in just the last 2 or 3 weeks. So I have a feeling that is a big part of the story as to why utilities are struggling as much as they are. As you can see here, it wasn't quite a clean sweep the way that it was in the energy sector, because we did have a water utility company here, American Water Works, AWK, was up 0.43%. And then we saw NiSource, I thought was going to be a positive one there, but even that one is down by 0.22%, as was PG&E. So as far as I can tell, the only utility stock that was up today was the water utility stock. Remember, water utilities are kind of unique. We talk about them quite a bit in my dividend growth investing classes, because those that exist out there in the publicly traded markets actually have pretty long histories of both paying and raising dividends. The problem is they are extremely regional and small compared to the bigger behemoths out there of the electric utility world. And so there's actually just one pure water utility company in the entire S&P 500, even though there's probably a dozen of them outside of the S&P 500. It's just that they're too small from a market cap perspective to be included. So that was the one tiny little ray of sunshine at the end of the tunnel here in the utility world today. It was pretty ugly once again. Another area that was ugly was healthcare. This has been rather remarkable to me. I will admit that I happen to like healthcare quite a bit. It's not my biggest sector. Consumer staples are as a dividend growth investor, but healthcare is right up there. And I seem to have a keen interest in many of these different healthcare related stories. And so I'm not a huge fan of seeing them suffer as much as they have. We'll talk about this a little bit more later on in tonight's session when we have our sector discussion. But this has been some relentless selling that we have been seeing here in some of these big pharma names that are in the healthcare space. So another ugly day for the most part in healthcare. You had a couple of bright spots. I see that Abbott Labs was up. I see that Edwards Life Sciences was up. X-Ray, which is Dentsply Sirona, was actually the best company in the entire S&P 500. It was up about 10% here today. Of course, focusing on more dental type of stuff, not necessarily pharmaceutical. So maybe that was an area where you could hide out here a little bit today. But for the most part, another pretty tough day, especially for the mega cap tech, or not tech, but healthcare oriented companies that were out there. So those were the areas that kind of caught my eye that were being a little bit more consistently read today. Also probably worth mentioning that NVIDIA, Apple, Microsoft, and Tesla were all on the negative side of the column today as well. On the plus side of the column, we did have Amazon from a mega cap perspective holding its own, up about 0.5%, and even Google managed to go up today, or as the kids call it, Meta. It's going to take me a while if you haven't noticed. Alphabet. So both Alphabet and Meta are the new names for Google and Facebook. So I'm kind of old school in that regard and have a hard time kind of spitting that out simply because my mind thinks of their original company names, and of course it doesn't help when Google is the ticker symbol for the new company called Alphabet. So I will apologize in advance if you guys hear me refer to these companies as Google and Facebook. But these days it's Alphabet and Meta, and Meta of course did change their ticker symbol to make it a little bit easier on us old school folks. But Meta is where you're going to find Facebook and Instagram, and of course their expected metaverse offerings. Today they had a big day. As you can see, one of the more important plus movers from a mega cap perspective. Remember, this is a $500 billion company, at least close to it, with $453 billion of a market cap. So this was an important 3% move that we saw out of them here today. And it was largely because of rumors swirling around that have intensified here recently that, TikTok could legitimately get banned here in the United States. Of course, a big rival to Facebook and other social media companies, with TikTok having Chinese ownership and the US and China having some more difficult relations revelations here recently. So we'll see where that story takes us, but that was the reason that Meta was able to do so well on a day when the S&P 500 was down. There were some other areas that tended to do a little bit better. It seems like financials were mostly in the green when it was all said and done today. And then you had a smattering of tech stocks that did pretty well, including Applied Materials up over 3% here today as well. I did want to also make special mention of Lind or Lindy. As you can see, it is one of the bigger squares over here in the somewhat small materials sector. So if we kind of zoom in here, you can see this is Lind right here. And some of you might have caught my tweet earlier in the day where that dividend aristocrat raised their dividend for the 30th year in a row. I believe it was 9% increase year over year, so a pretty solid one to boot. But that was one of the companies that did pretty well here today. Speaking of aristocrats in the material space, Nucor also had a pretty solid day, ticker symbol NUE. That's a steel company, up about 2% here today. All right, let's go ahead and now take a peek here at our actual breadth numbers. And we are on the Market Watch Visualize area of the Thinkorswim platform. You can see that we had about 200 out of the 500 stocks in the S&P 500 closing in the green today, with 300 of them closing in the red. So that's good for about a 40-60 split that we're looking at there. 40% of stocks in the green today, 60% in the red. So pretty split type of a day. It wasn't overwhelming for either the bulls or the bears. As I mentioned before, just the way that the day kind of shook out with the bulls being kind of in the driver's seat in the morning and then kind of giving way to the bears in the driver's seat in the afternoon. So we'll see where that takes us tomorrow. Remember, tomorrow is March 1st, and as you guys have heard me say countless times over the last 10 years or so that you've been listening to these videos of David and I's here at Market Scholars and also previously at TD Ameritrade, the first day of the month is a very interesting phenomenon. For those of you that are curious about it, you can pick up a copy of the Stock Trader's Almanac that comes out every year where they discuss this. But a surprising amount of the market's historical gains come as a direct result of just one single day each month, and that is the first day of the month. It's quite bizarre, and there are reasons behind it, perhaps, or at least speculations as to why that is. In the old days, a lot of money moved into retirement accounts on the first of the month and different things like that. But for whatever reason, that's a weird quirk within the market. And March is actually a pretty decent first day of the month. Of course, there are 12 first day of the months throughout the year, but March in particular is actually a pretty good one, generally speaking. In the last 23 years, the S&P 500 has been up 16 out of those 23 years. So definitely better than a coin flip. Obviously, every year is going to have its own unique circumstances and news stories that will come out on any given day. So that's far from a guarantee tomorrow. But generally speaking, if you're on the fence on the final day of the year and not sure if you should be bullish or bearish the next day, odds suggest, at least historically, that the bulls tend to win the day on the first day of the month. So we'll see if they can come through tomorrow or not, but just thought I would let you know of those statistics since it happens to be staring me in the face here with my desk calendar that I try to keep close to me throughout the trading day. All right, let's go ahead and now pop on over here, do some chart analysis, and take a look at our foregrid. And as you can see, this is chart 4B for those of you that are premium market scholars and you want to follow along. Remember, David and I offer you access to all 50 plus of our customized chart scripts that we offer for those that participate in not only our trading rooms that we teach, but also our question and answer sessions, and then also these free YouTube videos that some of you follow along with as well. So as we get started here, first thing that catches my eye is that we do have bearish postures across the board. Now that by itself is not a huge statement. Remember, that was the case last week already. But what did change just slightly here today is that all of these four charts are now considered strongly bearish, not just weakly bearish. Remember, the Dow has been strongly bearish for the better part of the last week, in fact, the full last week. These other indices were kind of trailing the Dow to the downside. In other words, they were holding up better. And the NASDAQ was the one that we kind of identified as this market's current leader. And you'll notice down below that the NASDAQ went from a light pink background color to a dark pink background color here with today's candle. And the reason for that is its green intermediate line on the market forecast technical indicator did cross down and below the 50th percentile of that particular indicator. And so it did kind of follow first the Dow that led the way there a week ago, and then after that was the S&P 500 a couple of days later, and then a day after that was the Russell 2000 just yesterday, and now today the NASDAQ finds itself there as well. So now we're in a situation where all four of our charts are considered strongly bearish according to the market forecast, and all four of these are also trading below their 30-day moving averages. However, there is some distinguishing elements of those 30-day moving averages, with the top two being worse than the bottom two, and that makes sense, right? That's effectively what we've been talking about in terms of leadership and lagging roles here within these indices in the last week or two. But just to confirm, you can see up here the S&P 500 has a red 30-day moving average. The Dow Jones Industrial Average also has a red 30-day moving average. And what that means is price is currently below a falling moving average, which obviously is a more bearish feature. On the two bottom charts here, the NASDAQ Composite in the lower left and the Russell 2000 in the lower right, both of those moving averages are still yellow. So that's a sign of conflict. What it's telling us is that price is below the moving average, but the moving average itself is still heading higher. One of those two things will eventually change. Either the price will get back above the rising moving average, or prices will stay lower for longer and pull the moving average direction down with it. So we're awaiting, further information there, but judging by how there's been a bit more selling pressure here recently, it shouldn't be a huge surprise if we expect to see the NASDAQ and the Russell follow suit of what the S&P 500 and the Dow Jones Industrial Average has already done. Now, in terms of a one-day performance here, the S&P 500 was down 0.3%. The Dow Jones Industrial Average was down 0.71%. Now, think about that for a second, because again, this is different than what your expectations would be in a normal market environment. And that goes to show you what we had mentioned before, which is the Dow is the current laggard of this market, and it's not even close. Even on a day like today where the S&P 500 was down, typically that would be a day when the Dow Jones is down less than the S&P 500. But because this is the area that investors are shunning aggressively right now, that traditional relationship is not holding up. So the selling momentum is real in the mega cap universe, and don't I know it. I am not having as well of a year in 2023 as I did last year, believe it or not, at this point, because of my focus as a dividend growth investor. Oftentimes, I like those types of companies that are the big lumbering giants that would make up the Dow Jones Industrial Average, but that is the last place you want to be hanging out in 2023. So far, obviously, we're only 2 months into this 12-month year. Things can and will change, but it is interesting nonetheless, because for big chunks of last year, the Dow held up much better in the downdraft than all the other three of these. In terms of these other two charts at the bottom and where they ended the day, the NASDAQ Composite was down 0.1%, so a pretty flat day for the NASDAQ comp. And then the Russell 2000, believe it or not, still managed to close in the green. So maybe that last minute of selling didn't really have as big of an influence on the Russell. I wasn't watching that one specifically, but if I were to pull up the S&P 500 here to show you what I mean, This chart right here in the middle is a 1-day, 1-minute chart. It's what I use on my trade grid, just to kind of get a sense of what trends are throughout the day on stuff that I might be trading or investing in. And here, the way you're looking at it here in the after hours session, I'm recording this a little bit later than normal tonight because some of you just saw my post on the website and on Twitter here a moment ago that I had to do my end of month tabulation of the sector attractiveness for the dividend stair-step chart. So anyway, I'm recording this market outlook video a little bit later than I typically do. But you can see here that there's a kind of a light part and then a dark part. That dark part is the after hours trading so far here this evening. The light part to the left is the normal market session. So I'm going to zoom in. First of all, you can see there was already this downdraft for the last couple of hours of the day where the market started rolling over. So that was kind of 2 hours into this, or 2 hours left, I guess would be a better way to phrase that. We kind of topped out with 2 hours to go when the market was up, and then we rolled over, we gave away all of those gains, and then we went into the red. Well, the final minute was really weird. Check this out. This is the final minute that you're looking at on the S&P 500, or at least the SPY ETF. I had somebody talking on Twitter afterwards that wasn't being specific about that, so I better be specific with you here as well when I say this is not SPX that we're looking at in this particular case, it is SPY. Regardless, you can see that whether you were looking at SPX or SPY, there was this huge sell-off in the final minute. If you stepped away from the markets with just 2 minutes to go, you probably got a little bit of surprise when you stepped back to your platform and saw the end result, because we basically went straight to the lows of the session on that final 1 minute candle. And prior to that, just with 1 minute before that, we were trading up there at about 397.30. So we basically gave up an entire dollar on SPY in 1 single minute as the closing bell was ringing. And you can see here we've gone down a little bit further in the after hours as well. As I zoom out a little bit, you can see that the after hours bid is slightly under 395 right now. And we closed the normal session after that really violent 1 minute candle at 396. So we're not only did we give up a whole dollar in 1 minute at the end of the trading day, we've given up another dollar already in the after hours session. Now, obviously, we have no idea whether that will hold going into tomorrow morning, but it has been interesting to say the least, and I didn't really see what sort of a news story would have caused that. I tried to look, I just didn't see anything, and some of the news headlines that were happening right at that moment were the news headlines about, the U.S. Politicians perhaps paving the way for President Biden to be able to, ban TikTok in the United States. But the problem with that is that rumor was already floating earlier in the session, so I wouldn't think that that would be the specific news that would cause such an abrupt sell-off in such a short amount of time, because remember, we're talking billions of dollars when we're talking about the S&P 500, even if it did just move like a dollar here in the case of SPY. So anyway, maybe more news will come out that I didn't hear at that time, but right now I'm not aware of any major news story that came out to cause such a violent end to the day. Nonetheless, kind of interesting to say the least. Anyway, that was the recap there on the 4 grid. All of these now strongly bearish postures, all of them trading below their moving averages. The Russell 2000 and the NASDAQ are leading more on a relative basis than the Dow and the S&P 500 because their moving averages are still going up. All right, let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support David and I here on Twitter and elsewhere with social media. I'm not really on much of the other social media outlets beyond what I do for work, but I am on Twitter a lot, and it is where I hang out during the day and share my thoughts and try to continue teaching and all that kind of good stuff there. And so in this particular case, 109 of you clicked like for me to last time I did the video on Thursday, and as I always say, as long as we're up and over 100 likes, I'm more than happy to give you a full-length version of the Market Outlook video that day, and so that's why we're doing it right now. If you prefer the shorter videos, don't click like, because if we're under 100 likes, then I will just plan on sticking to a 15-minute video where we only cover the indices and we just shut her down nice and early without any additional 12 grid analysis and sector selectors and trade applications and all that kind of stuff. So that way it gives you guys a little bit more control as to what you would like out of us. Obviously, this takes a lot of time for David and I to do, with at least 3 hours that go into looking for the trade ideas and developing the video and editing the video and sending out the notifications, all that kind of stuff. We don't have a staff. We do all this on our own, so we have to ask ourselves legitimately every single day, is it worth it for us to do a free video on YouTube where we don't get paid any money? And obviously, if you guys are getting value out of it, we don't think it's too much for us to ask you to click like free of charge for you. It only takes 5 seconds. So let's do some shout outs here. Thank you to Sandeep. Thank you to Dean. Thank you to Brandon. Thank you to Lucius. Thank you to Fathy. Thank you to Ayakipa. Thank you to Fred. Thank you to Arth and Judy and Sheila and Dave and Ken and Fun Jonesy and Terry and David and Chris and Pam and Susan and Margaret, HR, Tom, Dan, Sheila, Terry, Paul, Roger, Ann. There's too many of you to go through, Michael, Jeanette, but I do like to at least give you some shout outs here and there to let you know that we recognize you when your likes come in. It is something that is important to us because we are a very small company and we can't survive without word of mouth advertising. Because we don't have the marketing budgets of, the TD Ameritrades and the Schwabs of the world, right? So we rely upon social media to get the word out about our fledgling business, and we really appreciate those of you that are willing to support us in our efforts there as well. And by the way, what I had mentioned before regarding that post, you can see I just posted that to Twitter. So for those of you that follow me on Twitter, you can check out the sector attractiveness statistics from a dividend growth investor's perspective, judged by yield currently versus average high yield of securities over the last 10 years. And if you are not on Twitter, I also post it here to our website. And remember, in this area of our blog, the dividend growth investing area, this is available free of charge. So even if you're not a premium member of Market Scholars, you can still access this information. You can't attend my dividend growth investing class like I taught earlier today, which, by the way, we had a great discussion. Many of you know that Warren Buffett issued his annual shareholders letter over the weekend, and a lot of the folks that have been students of mine over time know that I am a big fan of Warren. He's not perfect. Nobody is. He's never claimed to be. But he does know a lot about the world of investing, and he's happy to share his thoughts and opinions, and I think a lot of people can learn from what it is that he has to say. Maybe I'm wrong about that, but that's my belief. And so I am somebody who has gone back to the shareholders meeting in Omaha every year since 2005, with the exception of the 2 years when it was shut down to outside audience due to COVID. So I'm somebody who tries my best to soak up as much knowledge as I possibly can from Buffett and Munger and company. And reading that annual report at the end of February of every year is also on my to-do list. It's like Christmas morning for value investors. And so today's dividend growth investing class was a little bit different than what my typical Tuesday morning DGI class routine is. Usually we go through some slide decks and kind of cycle through them over time, but today we had some fresh content there as I brought up the shareholders letter from Berkshire Hathaway and talked about things like yield on cost, where Warren Buffett and Charlie Munger and company bought Coca-Cola back in 1994 and now have a yield on cost on their shares of over 54%, meaning that every 2 years they continue to hold their shares in Coca-Cola. Just the dividend payments alone will completely pay for the $1.3 billion that they laid out for their shares initially, which is really quite remarkable. And they also have a 23% yield on cost on American Express. So there was some really interesting data points and tidbits that came out of the letter this year that focus specifically on long-term investing and dividend growth investing that I thought would be an effective use of our teaching time here earlier today. So if you are a plus or premium member of Market Scholars and you want to hear my thoughts on the letter this year and my analysis on it, feel free to check out the recording that is now posted up above here in the trading rooms area. Again, that is for those of you that are premium and plus members. If you're just a free member of our website, unfortunately, you would not have access to my classes. But again, feel free to check out some of these sector statistics, kind of get you a little bit more information, helping you understand where there might be some better opportunities than not within the marketplace here currently. Also, let's have a little bit of a chat here on the sector selector. And the sector selector, remember, gets done on Friday night, so it's a couple of days stale by this point here when we talk about it in the Tuesday video. Remember, the real reason I make this graphic is for my Monday morning top-down trend trading class, but I oftentimes am willing to bring it up and talk about it here in these free Tuesday videos as well, as long as, again, we've got at least 100 likes on Twitter, and we've got the time to kind of parse through it a little bit. As you can see, there was a little bit more changes week over week than what we had been used to, and we actually have a brand new number one. We have industrials back on the top slot. They overtook consumer discretionary. Now remember, this is based on an equal weighted system, not a market cap weighted system. And this is driven purely by price. It has nothing to do with fundamentals or dividends or anything like that. This is just purely based upon price. It's using a proprietary scoring technique that we use here called the WAR score, which is an acronym that stands for weighted aggregate returns, where we're looking at a few different time periods, and then we're weighting the results a little bit more heavily on the nearer term time periods than the ones that are further back. And that spits out a ranking system for us. And under that ranking system, industrials were able to overtake consumer discretionary. Now remember, consumer discretionary had been number one for 6 weeks in a row, so that was actually a pretty good run of success for them. Most sectors don't have the ability to stay on top for long periods of time. Last year we did see that with energy because it was such a strange market where you basically had 10 sectors that were doing really, really poorly and one sector that was doing pretty well. So that was a unique circumstance there. But traditionally, in normal market environments, you don't see sectors stay at the top week after week after week for long, long periods of time. So, credit where credit is due, consumer discretionary had a heck of a run there. And it's not even to say that they're done, right? Maybe they just came back into the second place for this week and they'll pop right back there in coming weeks. We shall see. But right now, we do see a number of those industrials doing pretty well. Remember last week we were talking about John Deere and Quanta Services, in addition to a number of other industrials related companies out there. So they're pulling their weight. In terms of the 3-4 position, we did have financials and healthcare coming in, and then technology slipped a little bit. Now remember, last week was a tough week in the stock market, and I'm sure that had an impact because tech is known as more of a growth-oriented sector. So naturally, when the stock market suffers in a big sell-off way, tech usually gets beat up a little bit worse than some of the other areas as well. Down on the bottom side, notice that we continue to have energy for the second straight week. So going back to what I had mentioned before in the heat map, it wasn't a surprise to see all energy stocks down today. We've known they've been under pressure. Remember, this was produced on Friday night with no knowledge about what would happen to oil companies here on Tuesday. But it just goes to show that, momentum and trends are real. And on a relative basis, energy has fallen out of favor. That can change. Obviously, it is very much driven by, geopolitical news and what's happening with Russia, Ukraine, and what the demand is in Europe for fossil fuels, and all these different things can play a role. But what we do know factually right now is that they are struggling on a relative basis compared to many other sectors that are out there. Also notice that utilities are down there in the second to last place. And remember, that was the other sector we looked at here today that was nearly a clean sweep of selling, with the one exception being the water utility there. So what we saw today was basically two entire sectors that every single company except for one within them were down, and they just happened to be the dead last sectors on the sector selector that I put together for you guys a couple of days ago. All right, let's go ahead and now take a look at our 12 grid analysis. And so we're going to start off here with chart 5A. This is our asset class 12 grid. And as you can see, it's kind of a mixed picture here today. It often is, so remember that because we're looking at a wide variety of asset classes here, you're almost always going to have some green and some red. But this is a little bit more of an equal split than what we had been used to. We've seen much fewer green charts on the board here late last week, but all of a sudden we've got a few more that are popping up. So let's talk them through. Starting with the lower left-hand corner, this is the US dollar, and the US dollar versus a basket of other currencies has continued to march higher ever since breaching this 30-day moving average on February 3rd. So we're basically into this a whole month at this point. Remember, prior to that, the 2 or 3 months before this bottoming right here, this was in a significant downtrend. So it has been interesting to see the complete reversal of that. And remember, that does not do us any favors traditionally as stock market participants. You can kind of look at the top here and see that while the US dollar has been rising, the S&P 500 has been going down. And then look at the opposite of that. When the US dollar was going down, the S&P 500 was rising. So, it's not that all stocks react to the dollar in the exact same way, but because of the way that the U.S. capital markets are currently formed, especially on a market cap weighted basis like the S&P 500 is, naturally you've got a ton of multinational companies here in the United States. Think about companies like Alphabet or Apple or even Coca-Cola or McDonald's. These are companies that do just as much, if not more, in most of those cases, business outside of the United States than inside of the United States, even though they're headquartered here. And so they do not like it when the US dollar goes up, because it makes it harder when they translate those euros and yen and all these other currencies across the globe back into US dollars at the end of their reporting period. It makes it appear as though earnings were down, or at least suffering on a relative basis, when the dollar is strong. So there are other companies that do business exclusively in the United States where the strong dollar is not as big of a deal. In fact, sometimes it helps them because they source their materials from overseas, and a stronger dollar allows them to buy more of those materials. But admittedly, there's a lot fewer of those types of plays out there than there are of the big multinationals that we're used to here in the United States. So that's been a big problem for this market, the strength in the US dollar. Remember, when the dollar is strong, you oftentimes find that commodities can be weak as well, and that's also what we've seen here with gold. Gold was actually up today, as was oil, so that's kind of interesting to note that oil stocks did so poorly today, even though oil, the commodity, was up and in the green when it was all said and done. Nonetheless, you can see that ever since the US dollar bottomed here just over a month ago, that gold topped and has gone down. And so we'll see. We finally did get, by the way, a oversold cluster signal on GLD. I was with you on Thursday, and that had not yet happened yet, even though we were talking about gold and how it had been kind of in this house of pain, and we're kind of waiting for some sort of a bright spot or a reason to think about a trade there. Well, the very next day, on Friday, you did end up getting an oversold cluster signal, and now gold has gone up 2 days in a row. Now, the way that I think about oversold cluster signals is, first of all, I want to know, has there been a lot of them lately? In the case of gold, there hasn't, so I'm going to consider this one a little bit more legitimate. In other words, I would expect a reversion to the mean type of a move. But I think sometimes people misinterpret me when I say that, and they assume that when I say reversion to the mean, that they're expecting the stock, or in this case, the ETF in question, to go right back to where it was before the conditions that caused that oversold cluster signal, and that is not how I think at all. I think of a minor reversion to the mean type of a move, and sometimes it can just be sideways, but more often than not, you do find some sort of a bounce. But usually it's a bounce that ends up in a whimper as the bounce gets up towards the falling 30-day moving average, then the sellers come in again, and then you could very well be breaching those lows within another, let's say, 3-4 weeks or something like that. So anyway, it's good to see that it's gotten so bad it can be good in the short term, but that does not necessarily mean that we're out of the house of pain here in gold. So be very careful with that. It could very well work in the next few days, but is it going to work in the next few weeks? That is a lot more questionable there. Oil has been just mostly tracking sideways. Notice that gold has a strongly bearish posture. Oil is actually weakly bullish, but it's not really trending bullishly. It just happens to be in the midst of a bounce right now when we're having this conversation, so that lends itself to the light green color there. But as you look at this, you can see it's clearly still below its moving average, which is falling, and therefore until we start breaking out above this double top up here, I'd be a little bit cautious around oil as well. And then Treasury yields down into the lower right-hand corner, you'll notice did close a little bit lower today, but not much, right? We still ended the day at 3.91% on the 10-year Treasury yield, which you can see here is basically right next to 3-month highs. And so, again, that's part of the reason from my belief system why utilities are doing so terribly right now, as are the REITs. Those are the two most interest rate sensitive areas. And so when Treasury yields go straight up, REITs and utilities, all else being equal, struggle on a relative basis. Notice as well that when Treasury yields go up, typically bond prices go down. And here over the last month or so, we've certainly seen that with TLT rolling over, with BNDX, which is foreign bonds, rolling over, and even with HYG, which is high yield bonds, rolling over as well. High yield bonds look a little bit different than the other two because they bounced enough off the lows about a week ago to now change their background color to that light green, telling us that we have a weakly bullish posture, not strongly, but weakly. But hey, you got to start somewhere if there is going to be some sort of a reversal. And like I mentioned when we were talking about it last week, you know, at least with the junk bonds, they did not breach their prior low, right? Some of these other areas are getting awfully close. Foreign bonds got a little bit closer and could still be in the midst of that sell-off right now where they could breach those lows from the end of December within a day or two under the right types of circumstances. Whereas there's a lot more breathing room here on HYG. And remember, HYG is going to be a little bit more of a temperature check as to whether the market is willing to take risk, and the market's a little bit more willing to do so this year. And remember, there's also a lot of those oil companies there as well. So when oil prices go up, sometimes you find that high yield bonds react more strongly as a result of that as well. So right now, oddly enough, the junk bonds are much stronger than foreign bonds and U.S. government bonds here at the moment. Remember, government bonds oftentimes are viewed as a bit of a safe haven type of a trade. And so in a year like 2023, we really haven't needed as much of a safe haven trade because the stock market's up. So that role hasn't really been utilized quite yet. But I personally would not be surprised at all to see that actually take place later this year. Now all of a sudden the stock market is starting to feel a lot shakier than it was just in January, and who knows if we start heading for those lows again later in 2023. I personally believe that this is a year where the bond market has a decent chance to outperform the stock market. Obviously not a guarantee on that, but just kind of what I'm envisioning in my head about how I think things could play out this year. So, I don't think TLT is dead forever. Yes, it's struggling right now, but it is trying to stabilize at an important double bottom area and could very well start collecting investor interest if the stock market starts rolling over here moving forward. But obviously, there's also the Fed that comes into play, and the Fed right now is not done raising interest rates. And so you'd like to see us get a little bit closer to the end of that interest rate rising environment before you could take a leap of faith that the bond market is going to get really strong from that point afterward. So it might still take, months from now until we see a really robust move in the Treasury bond market. But something to think about, park in the back of your mind for down the road, and maybe there's going to be some opportunities there. Up on the top rung, as I mentioned before, the U.S. stock market is struggling right now, trading below its falling 30-day moving average. Interestingly enough, we really don't have any sort of better types of movements in the foreign markets right now either, and that's probably because the U.S. dollar is strong. When the U.S. dollar is strong, foreign stocks will struggle on a relative basis, all else being equal, for the same reasons I mentioned to you a moment ago with the multinationals here in the United States. It appears to us, our eyes here in the United States, that the foreign stocks have poor earnings when the dollar is strong versus, let's say, the euro or the yen or the yuan or what have you. And so this has not been the best of circumstances for foreign companies here in this rising dollar environment. And today you did find that the foreign areas of the world were down worse than the U.S. markets were, with the dollar being up 0.28% today. So EFA, which tracks Europe, Japan, Australia, etc., was down 0.73% today. And the emerging markets, which tracks China, India, Russia, Brazil, Mexico, etc., it was down 0.7 today. So both of them were pretty much in alignment with how much they were down, and both of them were down almost double of what the S&P 500 was down. Preferred stocks actually were one of the few bright spots here today. We don't talk a lot about them because there's not a whole lot of liquidity there, and quite frankly, they'll bore you to tears. But preferred stocks were up 0.25% here today and do have a weekly bullish posture. Bitcoin, by the way, was fairly steady considering the sell-off that we had at the end of the stock market today. Bitcoin, as we speak here, only down 1% and obviously still has that strongly bullish posture as it's trading close to about 23,000 per Bitcoin at this point. Let's now take a look here at our sectors. This will be chart 5C. And as this pulls up here, it's getting harder and harder to find some green charts on the board, but there are a few. So let's maybe start with those, starting with the only one that is the dark green shading, and this is XLI. Now, remember, when we're looking at XLI, this is a market cap weighted ETF here in this case, an approach towards judging strength versus weakness. Versus what I had showed you earlier in the session on the sector selector, that was it was an equally weighted approach. But both of them confirm the same thing. Whether you're talking about the average small or mid cap industrial, or you're talking about the biggest industrials out there, they're both telling us that these are the strongest areas from a sector perspective here, at least from that one element of how do you set your posture. Technically, you could get away with saying that technology's intermediate reading is slightly more because technology is at 57, industrials is at 51, so you could get away with saying that, but the problem is, of course, their line on technology is falling, so you're seeing a loss of momentum there, whereas on the industrials, the 51 line is rising, and therefore you're seeing some sort of a gain of momentum, at least on a relative basis. So, those two aren't probably that far away from one another, but it does go to show that, hey, at least there are some areas of the market that are trying to stabilize when it seems like we're getting a lot of selling pressure elsewhere. The other thing that I was going to mention with the other two is, first of all, materials were up 0.45% today, and then financials were up 0.2% today. And those were some areas when we talked about them on the heat map that kind of makes sense to me now that I look at it as well. Remember, there were a lot of financials that were up, and then stocks like Linde and Air Products and Nucor Steel, and those were up today as well in the materials space. Also, by the way, real estate was up today. It's been a really tough go. In fact, I was surprised when I was going through my sector statistics that I was mentioning to you earlier that I posted. Real estate really fell off month over month. That's usually how I'm tracking those statistics. And out of the approximate 50 REITs that I track in terms of attractiveness out there, we look at overvalued versus undervalued. Out of those approximate 50 REITs, only 4 of them were in the overbought territory based upon the average high yield theory that I teach to my DGI students. And so basically saying there's hardly any REITs that are considered overvalued right now, and there are a lot of REITs that are considered undervalued right now. Could they become more undervalued? Of course, that can always happen, but it is just a way to judge through history what is outside of the norms. And right now, there's been some pretty intense selling here in just the last month, where that really kind of caught my eye, because a month ago, when I did the exact same statistics here at the end of January, you can see the REITs were way up here, and they've fallen all the way down here during that month. So a lot of those REITs that were once overvalued just a month ago have now fallen in kind of the neutral territory on my dividend stair-step charts. Anyway, not a whole lot of bullishness out there today. So let's talk about the bearishness now. The worst performing sector appears to be utilities, which is maybe a little bit surprising. Not tremendously so, because we saw that only one utility stock was up today. But usually on a day like this that's a little bit more aggressively sold off, you're going to find the more cyclical areas like energy do worse than utilities. And energy, remember, had every single one of its components in the red today. But strangely enough, energy was only down 1.44% today, whereas utilities were down 1.75% today. And notice, here we go again. Utilities are back into that oversold cluster zone again, right? We were just there last week, and of course we were there a couple of weeks ago as well. So this is now the third oversold cluster signal here in basically the last month. And that's pretty rare for utilities. Remember, a general rule of thumb is that the slower the underlying holding that you are checking out on the chart, or the more boring or quieter the chart, whether we're talking about an individual stock or in this case an entire sector of very boring companies like utilities, the slower and more quiet the chart, the less you will see oversold and overbought clusters. And oftentimes it makes them more valuable when they do appear. They are more legitimate. Whereas when you look at other really wild stocks like, I don't know, Carvana or Tesla or something like that, those types of companies always have tons of overbought and oversold cluster signals. So it's been kind of interesting to see utilities, which traditionally doesn't get those cluster signals, have 3 of them now in the last month. And I have no doubt that there's some interesting value starting to emerge within the utility sector for those of you that are willing to be brave and do something counter-trend. There's probably a number of utilities that are kind of unfairly punished in this environment that could very well end up snapping back under different market conditions into the future. You'll also notice that healthcare is suffering with an oversold cluster signal of its own. Now, remember, healthcare on a equal weighted basis was actually in the middle of the rankings of the sector selector. So unlike what I just got done telling you about industrials, where those two things confirm one another, this is not telling you that. What this is telling you is that the mega cap healthcare companies are really taking it across the chin right now. They are getting hit hard and aggressively and consistently as well. Whereas the mid caps are probably hanging in there okay, and the small caps as well, because on an equal weighted basis, healthcare does not look this bad. But on a market cap weighted basis, it looks terrible because you've got stocks like Pfizer that seem to go down every single day with $200 billion plus types of market caps out there. In fact, I think I heard a statistic, maybe on CNBC the other day, that if I were to change this to a weekly chart, so let's go to a 1-year weekly. Yeah, this does look like a legitimate statistic. Notice that for healthcare, this is XLV that we're looking at right here. We are currently down 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 weeks in a row. Now, this week's not done. Obviously, it's only Tuesday, so this could change. If we get a big rally between now and the end of close on Friday, it doesn't have to be 10 weeks in a row. But right now, it's been a pretty aggressive selling so far in the first 2 days of the week. It's looking like we are on pace for our 10th week in a row of downside action in XLV, which is basically unheard of. This is actually a really good segue into our trade application example. So let's have that conversation right now. And I mentioned to you guys earlier in the presentation that sometimes you'll get a hint as to what David and I might end up talking about in the Market Outlook videos if you follow us closely enough on Twitter. And here on Twitter, here in recent days, I did post about the company that we'll be doing our market outlook video on here tonight. So let me explain. I did retweet it here just before I started recording this, so that way I could bump it back up to the top of my timeline for those of you that didn't catch it over the weekend. But I had mentioned here on this tweet, said that Johnson & Johnson currently has a weekly oversold market forecast cluster signal. If it closes here today, so this was on Friday when I had posted this originally, this will be just its second occurrence in the last decade of that weekly oversold cluster signal. I also go on to say that Johnson & Johnson has now been down 7 straight weeks. And then I asked, does anybody want to guess how often that has happened in the last 2 decades? Not a whole lot of people were playing my game when I was asking the question there. Nonetheless, I'll just spoil the surprise and let you know that the answer is 0. Johnson & Johnson has not been down 7 weeks in a row at any time in the last 20 years. The last time it happened, you'd have to go back to 2002, which was just beyond 20 years. Nonetheless, it was more than 20 years ago that happened in the aftermath of the dot-com bubble. And by the way, thank you to those of you that helped support this this tweet as well. 125 of you clicked like, and usually if I get a random tweet like this up and over 100, I know that those are tweets that you guys like to see. And remember, I judge my tweets the way that you would assume that I would. In other words, I look at how many likes I'm getting on those and interactions and things like that, and I'm trying to train my brain so that way anytime we have a tweet that gets a lot of likes, I want to do more of that type of content in the future. So if there's ever a time that you like a type of content that David and I are tweeting about, it would be in your own personal best interest to click like there, because you're basically training David and I to tweet more about that type of content and topic in the future. So thank you to the 125 of you that did that for this one as well. And it kind of trains me to say, okay, well, if I see these types of setups again in the future, I better go out and tweet about them more, as opposed to the random tweets out there that might get like 5 likes or something like that, right? So I hope you guys kind of understand that, and sometimes it's helpful to put you into our shoes there as well and let you know how we think. And so again, thank you to those that did click like there. But here's what I had posted as far as what the chart looked like on Friday. Now, this was before the closing bell. And so I do want to confirm as well that by the time that Johnson & Johnson did close, they did end up officially closing with that cluster signal. So the only other time we had that cluster signal was back here in 2019, and you can see that Johnson & Johnson went on a pretty epic rip back higher immediately after that weekly oversold cluster signal there. And so let's go ahead and now talk about tonight's trade application example back on here on the main part of the platform. And I'm going to pull up Johnson & Johnson on chart 2A, which is our dividend stair-step chart. And these blue lines that you see on the dividend stair-step chart represent where would be attractive times to buy a dividend growth stock with a long history of growing dividends like Johnson & Johnson based upon historical measures. In other words, is the current yield attractive compared to the extreme yields that have been present throughout the last decade with this particular company? And remember, the dividend stair-step lines are unique to every single one of the 700 companies that I cover on those. And so for Johnson & Johnson, their unique area is with a yield of 3.07%. Currently, the stock is yielding 2.95%. So in other words, with this stock trading right here, it's not quite a buy yet based upon the rules that I teach in my dividend growth investing class. But because it has been down 7, right now 8 weeks in a row, if this holds this week as well, we are rapidly approaching that blue line. And sometimes people start getting a little bit of an itchy trigger finger, so to speak, and they want to do something bullish because they're like, I can't let this opportunity pass me by. But at the same time, they don't want to break their rules. And they say, well, the rules say this, and and obviously you can make your own rules, but for our purposes in my class, we would have to wait until it got down to that blue line there. And so I teach another class on Monday afternoons called Options for Long-Term Investors, where we look to rectify that situation. In other words, we look specifically for these types of setups with stocks that have long histories of growing their dividends. And remember, Johnson & Johnson is truly one of the elites from that perspective, with over 60 years in a row of dividend increases. And you see a moment in time where it is aggressively sold off, And if you are making the leap of faith that Johnson & Johnson is not going to go bankrupt and not go into the dustbins of society, then eventually value investors and income investors will step in and support the stock's price. And you can see that in the past, there's been plenty of times that when it gets down to this blue zone, like it did right here, like it did back here, like it did back here, like it did back here, and back here, that market participants were willing to step up and buy it. And so in this particular case, I thought it was a good example to show you of what's known as put selling. You can do this in either a regular taxable account, or you could even do it in a tax advantage account like a Roth IRA. Of course, in those IRAs, you do have to do it on a cash secured basis, meaning that you have to have the money set aside to take ownership of 100 shares if push does come to shove. But effectively, what you're doing is you're picking a point on the chart where you would like to be a buyer of that security. And what I did today is I sold the April 145 puts on Johnson & Johnson for $1.46, which is just a little bit more than a 1% return on risk, which is oftentimes what we shoot for that particular trade setup. And you can see here on the chart that Johnson & Johnson at 145 would be approximately right here that I'm circling with my mouse. In other words, it would go from being in the white neutral zone to then clearly being into that blue zone that has been viewed as so attractive for Johnson & Johnson shareholders throughout time. The other nice thing about that is you actually get a premium when you do that trade. So, it's not just that we would take ownership at 145 if it were to close below there on expiration day in April, but we could subtract out the $1.46, and our true cost basis is actually 143.54. And let's see here. 143.54. That would mean that our yield at that point, based upon our adjustment on our true cost basis on Johnson & Johnson, would be 3.15%. And you can see that would be well in excess of the 3.07% that we would require according to the rules of the class that I teach. So I thought this was a really good example. Now, today was not a day where the market was down 1%, but remember last week we missed one of those days because we didn't get to 100 likes on Twitter. So I kind of view this as a makeup trade there on a company that I admire quite a bit here with Johnson & Johnson that has oversold weekly clusters that has only happened a couple of times in a decade and is approaching an area that has easily been shown to be beneficial to long-term investors throughout history. Okay, so that's what I had for you here tonight. If you enjoyed this trade application explanation and setup, I ask one simple thing out of you. Click like for me there on Twitter. As long as we're up and over 100 likes by the time I'm scheduled to do the video again this Thursday, so a couple of days from right now, I will plan on doing another full-length video. On the other hand, if you don't really get much value out of these trade application setups and the 12 grid analysis and all that kind of stuff, and you just want a quick 15-minute version of the video, then don't click like. And as long as we're under 100 likes, then I'll just do a very quick hitter type of a video there for you on the indices alone. So we'll let you guys decide there collectively. Regardless of what you decide, I appreciate you checking out tonight's video. David should be back with you tomorrow, and then I'll see you one way or another on Thursday. Until then, best of success with your trades and your investments. Goodbye for now.